another episode of Multifamily University. It is June of 2023, summertime. Hope you're all having a good time and planning to have a great summer, lots of vacation on your mind.
By the way, Anna, are we recording? Just want to make sure in case
yes, we are. Okay, it's recording by default. Awesome. It should have been, in fact, if you look up in the left-hand corner, it says recording, but always a good thing to ask, Brett. I appreciate you checking that out. Okay, cool. So we're here with Brett Swarts for a pretty interesting, there's so many people that are coming to this, which shows how many people are really intrigued with this topic, capital gains tax exit plan. We all want to know it because no one wants to pay capital gains. I know I don't. I have a lot of strategies that I try to use and learn about to avoid paying capital gains on my exits. So Brett is going to teach us a lot here. But before I turn it over to him, I do want to let you know that yes, we are recording this. And yes, you will get a copy of the PDF of the deck that Brett is showing you. So that will be included with the replay. You are welcome to ask questions. Please ask them in the Q&A, and we will answer those at the end. I'll be firing those off so that Brett will answer as many of those questions as we can. And with that, I'm going to turn it over to Brett.
Amazing. Thank you so much, Anna. Is it okay if I kick it off with a video just to get the energy up? Man. And it has a little bit of music to it. And so give me 1 second as I share my screen and share my sound. Here we go. Share sound and share.
Are you telling me that you have a way to defer the tax situation there? Is that what you're telling me?
Yes, absolutely. Yes. And so the first one I was referring to is a 1031 exchange, which only applies to investment real estate. The second one I'm referring to is called a deferred sales trust.
A real eye-opener to see that there are ways that people can use the regulatory framework, if properly structured, to invest 1031 exchange dollars in things that you would not think were like kind to what they exited from. So it was very impressive. I got to say, you are the first one I've seen pull this off, and I'm pretty hesitant to believe in a lot of these kinds of things. So it's a major feat for me to say, wow, this actually really worked, and it was really cool.
1031 is a way to shelter your income when you sell the thing. The DST is a way to avoid the 1031 and not have to suffer the time penalty.
Our career and during different tax periods, we've seen, these tax avoidance, tax minimization, offshore, all these different strategies undertaken to minimize or avoid taxes. And then I can tell you that, some of them are just not worth the trouble. And so I was skeptical. Admittedly, I was skeptical. I thought, oh yeah, here we go, another one of these, right? And then they say, no, it really is different, right? So look more closely. We looked more closely. We had, honestly, 2 years of conversations. 2 years. Now we were being due diligence at the same time that we were doing due diligence, but 2 years is a long time to be, sort of flirting with the idea of and getting to know the people and getting to really understand the transaction. Yeah, long story short, we got comfortable, although we are not tax attorneys, lawyers, or estate planning attorneys, that at least, from an investment perspective, that, it made sense to sell a highly appreciated asset, get liquid, hold that in this type of a deferred or installment sale type of instrument, and then just be in a position then to do the most important thing. I'm probably stealing your next question, which is time. They say, well, you can't make more time. You can. The deferred sales trust, in a way, allows you to lengthen the investment time horizon for those assets after getting liquid, but before having to feel the tax impact. And from an investment manager's perspective, time horizon is the most important element in investing.
All right, everybody, let's get started on this. Now I'm just going to share the other part of my screen. And we will be live for this. All right. So thank you so much, everyone, for being here tonight, wherever you may be listening and attending. We're talking about how to build an effective capital gains tax exit plan. a proven strategy. Who here has seen the movie Meet Joe Black? And if you haven't seen it yet, I highly encourage it. It's really an entertaining movie. There's a scene where Brad Pitt and Anthony Hopkins it's towards the end of the movie. And they're trying to negotiate this deal, this opportunity for Anthony to exit. And they're talking about death and taxes. And so in this world, nothing can be said to be certain except death and taxes. And by the way, as a part of that, capital gains tax is a part of that tax, although there are ways to defer it, and there are ways to potentially even mitigate or create losses to offset it. But if you don't do that, they are typically 25% to 50% of your proceeds are going to be wiped out by capital gains tax and depreciation recapture. And so we're going to talk about how to build an effective capital gains tax exit plan. And we're going to start with this first page here, which is the financial aspect of this, right? Effective can mean different things for different people, but financially, I actually asked ChatGPT what they thought an effective capital gains tax plan might look like as it pertains to the DST. And here's some of the things that it came up with. Capital gains tax deferral is the number one way, right? Because you want to make sure to, not get taxed on the sale of an asset, but an effective one would work for any asset of any kind. It also would defer until the seller or taxpayer actually receives the payments, right? So it's using what's called the law of compounding interest, right? Which goes into your favor if you can earn interest on capital and defer the gains. And so the first one would be capital gains tax deferral. The next way to build an effective capital gains tax exit plan would be investment opportunities. And I think this is the key here, the freedom to invest the funds in any asset of your choice. And here's also the key, without restrictions or timeframes for investments to be made. Another way financially to make, I think, an effective capital gains tax exit plan, and I agree with ChatGPT 4 here, which is flexible payment structure. In other words, that you have tax flow optimization. Future payments of cash flow over a longer period of time unlocks compound interest in your favor, as well as estate tax benefits, eliminating what's called the estate tax or the death tax, asset protection, and debt freedom. So what is an effective capital gains tax plan personally? Because it's not just about financial freedom, right? It's also about some of the personal freedoms that you might want to unlock when you go to exit highly appreciated assets. And that could be just your time and your energy. I know I have a lot of clients and a lot of people who we help that are looking for just their time. One thing that COVID taught us is only so much time on this earth, and it kind of exemplified that. And people want to be able to exit their high-end primary homes, their businesses, their commercial real estate, their cryptocurrency, and they want to be able to spend their time and their energy with the things that they want to be doing, whether that be working, whether that be starting a new business, whether that be retired. And so having the ability to have time freedom when you exit is so important personally. As well, what's also effective? Well, the entrepreneurial freedom, the ability to start a business or to go into another real estate opportunity, actively or passively, I think is an effective way to get personal fulfillment for maybe some of you who are listening today that perhaps, and we'll share some deal stories that exemplify this, but what is it that you're in right now or that you could sell that could unlock the capital to fund your next entrepreneurial freedom adventure, right? Also, passive cash flow freedom. I know for some of us, we're tired of the toilets, trash, liability, and the active management of real estate, especially in states that are becoming more and more challenging to operate and own businesses in real estate. And so the ability to have passive cash flow and not have to actively work for it is also, it kind of ties into the time one, but there's something about that I think a lot of us desire. As well as just the 1031 freedom. How many of you have ever been in a 1031? If you have, you can put it in the chat. More so, what was your experience with that 1031 exchange? Did you feel like you're buying the property based upon the intrinsic value? Do you feel like the tax tail was, or the tax dog was wagging or the tax tail was wagging the investment dog? In other words, you wouldn't have bought that property if it wasn't for the capital gains tax that you were about to pay. Or have you ever been in a situation where you had a failed 1031 exchange, right? Where you ran out of time, or the seller wouldn't deal, or the lender wouldn't lend, all of the things that are out of your control, which created a failure and a tax on the sale of your asset. Or perhaps even you're looking for location freedom, or you're looking to sell a high-end primary home. I know we helped a client who sold a high-end primary home in Palo Alto, and they were moving to Nevada to establish residency, to move closer to family. And a lot of their capital was tied into their primary home, and they're looking for a way to defer capital gains tax. Perhaps it's partnership freedom. There was another deal we just helped a client with the $13 million car wash down in San Diego, and they were looking for ways to separate and be tax deferred, but didn't want to all go together in the same deal. Or it could be estate planning, just looking for flexibility for your assets for your heirs, meaning that you don't have to, the kids don't have to argue over what is going to be something that that could be fixed now by you selling now, and avoid the arguments later with the assets that are going to be sold. And so these are all the types of things that I think create personal fulfillment when it comes to, and that's just as important as the financial fulfillment when exiting, as well as charitable giving flexibility, also short-term or long-term gains as well. So here's a question for you. What's the most effective capital gains tax plan? Well, we believe it's the one that combines both financial and personal freedom and the impact you desire. If there's anything you can learn, or I want you to glean from this this time we have together, is really clarifying what it means for you and your vision for your wealth plan, for your time and your energy, for the impact you want to make with your wealth, and also clarifying what the capital gains tax liability is for you, and what that would mean if that capital could be working for you. So it's a financial conversation, but it's also a personal freedom and impact discussion. What we believe, and I want you to consider.
Brett,
go ahead, Anna.
We have some people asking, are you sharing your screen, because we're just seeing your beautiful face?
Oh, I'm so sorry. I was, and let me try to share that again. I probably should.
Thank you to our audience. There you go. I was starting to wonder myself, but you were just rolling with it. I'm like, he's just so passionate about this stuff.
So I'll click through this pretty quickly here. Can you see my screen first of all right now?
Yes, we can. Thank you so much.
I'm sorry about that. So this was the page, Meet Joe Black. Okay, so you guys caught that. Check out that movie. And yeah, if you want to, we'll have a copy of the slides, of course. But these are some of the things to really consider. But let me just fast forward for sake of time. And that has to do with what's the most effective capital gains tax plan? Well, it's the one that combines both financial and personal freedom and the impact that you desire, right? And that's so important. It should really be customized, flexible, and the one that's going to serve the hard blood, sweat, and tears and the risk you've taken to build wealth over 10, 20, 30, 40 years. And you're looking to make this exit, and it's the fourth quarter. There's 10 seconds to go. And guess who's with their hand up, ready to grab, to grab may not be the great word, but ready to take their fair share, if you will, 25 to 50% of your total proceeds. And that could be, used to impact the things that you believe in most, to create more wealth with more business ventures, more real estate, to solve things like the housing crisis that's going on, which Neil and Anna are on the front lines of creating, building and investing into multifamily housing. And so we're going to talk about some stats about that. But that really the biggest thing is just clarify that vision for your wealth. And then you're going to figure out what is the most effective, outcome that I want to see happen. And then what's the team and the strategy to help me to accomplish that. So I want you to consider over the next, 30 or so minutes, we're going to go through this presentation, then we'll open up for questions. The deferred sales trust. And by show of the chat, when Anna first mentioned the DST, were you thinking about the Delaware statutory trust? Because I don't want you to get confused with that. That is a form of a 1031 exchange. What we'll really be focusing on tonight is something called a deferred sales trust. Now, the Delaware statutory trust can be amazing in a lot of ways, and we'll talk about some of the amazingness. We'll also talk about some of the challenges there. Same with the deferred sales trust. It can be amazing in a lot of ways and some of the challenges as well. The 1031 exchange likewise. It's not a one size fits all. It's the first thing to understand. But we do believe that the deferred sales trust can solve a lot of those effective challenges or those effective desires that we talked about financially and personally, better than anything we've seen so far. And so I'm looking forward to this discussion. So we're going to cover most of this, and we'll also compare and contrast. And by the way, who's the deferred sales trust for? Or if you or your investors or your clients, depending on what they're selling, they can be of anything of any kind, has at least $1 million net proceeds and $1 million gain per transaction, you qualify. And it can be for any asset of any kind. This includes cryptocurrency, NFTs, business sales, investment real estate. It can save a failing 1031 exchange, even past your 45 days. It can work for GP or LP interest. It can work for primary homes, private stock, public stock, carried interest, captive insurance, artwork, and collectibles, really any asset of any kind. As a comparison, the Delaware Statutory Trust and the 1031 exchange, they only work for one of these. Do you guys know which one that is? It's only investment real estate, right? And so if you have any of these other assets that are highly appreciated, the 1031 exchange doesn't work for any of those, right? Whereas the deferred sales trust, one of its unique advantages for building an effective tax deferral plan is that it actually defers the tax, right? You don't want to sell something that doesn't defer the tax. That's number one on the most effective way to build a plan is tax deferral, right? So that's key. By the way, who is the deferred sales trust not for, right? So maybe the asset you're selling does not have $1 million net proceeds and $1 million gain. Now you might be asking, well, Brett, why is there a minimum? Well, there's fees involved, and that's part of the pros and cons of this. But we have to make sure that the ROI makes a lot of sense. The bigger the deal, sort of like if you buy 50 units of apartment complex versus 150 or 200, the bigger the deal you buy, the more it can scale. Same concept with the deferred sales trust. The bigger the assets under management or the assets that you're selling, the bigger the tax, the more it scales. You also perhaps wouldn't do this if you want 100% of the capital right now, meaning you want to spend it all on a primary home or all on a boat or a car. Anything that's, personal consumption is not going to be tax deferrable with the deferred sales trust, although you can earn interest off of the trust and pay tax slowly. And we'll talk about that here in a minute, and spend that on whatever you want. You also, you might have carry forward loss. Before you do any tax deferral strategy, including a 1031 exchange, Delaware Statutory Trust, or deferred sales trust, find out if you have some losses that have carry forward that you can offset today. And just check with your CPA. You don't want to forget about those losses. You want to be able to use those to offset gains you have. So if you have carry forward loss, you can offset capital gains tax. Consider that. Also, you have an amazing or really good investment to 1031 exchange into. 1031 exchanges are very inexpensive, about $1,500 on average. And, you do give up your proceeds for 45 to 180 days, depending on the deal when it closes. But if you have a solid 1031 exchange to go into, by all means, we love 1031 exchanges. I'm a multifamily broker by trade. I grew up in the real estate industry. More about me in here in a few minutes, but those are great, and you can build wealth. It's the top way that people have built commercial real estate wealth in America, really in the past 30 years, I believe, is by doing these 1031 exchanges. The key, though, it can also be dangerous, and we'll talk about that here soon. You also want or need to spend all of the funds. I talked about that one already. You don't have a 40% estate tax challenge. Let's define what the estate tax challenge is. If you are married right now, it's a $24 million basically exemption as of right now, meaning anything above and beyond that is subject to a 40% death tax. And so, Anna, I don't know if you know this, but we've been taught that the 1031 exchange is the end all be all. You swap until you drop, right? And then you get that stepped up basis. The challenge with that is it only applies to capital gains tax. It has nothing to do with the death tax. And so you want to make sure that you're having an effective tax, capital gains tax exit plan. It's not just capital gains tax, it's also the estate tax. It's kind of a bigger discussion here. But essentially what it means is the 1031 exchange does not remove funds outside of your taxable estate, which would be subject to a 40% death tax, whereas the deferred sales trust does. And so if you don't have those big problems, and if you're single, it's about 12 to 14 million right now is your total estate that's exempt from that 40% death tax. However, in 2026, those numbers are set to cut in half, which would mean about 6 to 7 million single, or about 12 to 14 married would be the exemption. And so the simple math is, what's my total estate value? How much is inside of my taxable estate? And what's my plan to get the funds out if I want to eliminate that 40% death tax? And the last ones would be who the deferred sales trust is not for. The fees are just too expensive for you. You don't see a clear way to make the deferred sales trust an investment and not an expense. By the way, one of probably the biggest drawbacks of the deferred sales trust is the lack of public awareness. Again, back to the chat of how many have heard of the deferred sales trust before this presentation, right? If you have, put in there, yeah, I've heard of it, right? Maybe you got it confused with the Delaware 1031 or the Delaware statutory trust. It was confused all the time. Yes, it's the same DST. So one of the biggest drawbacks of the deferred sales trust is just the lack of public awareness. And it often causes what's called, the biggest question is, it just seems like it's too good to be true. Is this too good to be true, that I can defer taxes on any asset of any kind, and I can go back into real estate and different investments at any time. I can diversify, I can pay off my debt. We'll go through a lot of these details, but understanding that this tax code that the deferred sales trust is based upon is section 453. You can look that up. It's an installment sale method, which is the foundation of the deferred sales trust. This may scare some people off, but some people do installment sales all the time with regular sales. And you might decide that the risk of the audit is having to pay the tax plus the interest back to the IRS is not worth it. Although I want you to really consider the track record to help, hopefully ease some of those nerves even up front, that the deferred sales trust is batting 1,000. It's perfect so far. Over 27 years, thousands of closes, billions successfully under management, and over two dozen successful audits. No change, no finding audits. And these are including formal audits, most of these audits in California. And it's also never appearing on the IRS watch list or the Dirty Dozen. And so it's batting 1,000 so far if you have a team to execute it properly, which is so important. It's not just the idea, it's the team. It's just like if you're buying into one of the multifamily investments with like Anna and Neil, it's not just the investment, it's a team to execute that business plan to make sure that everything is going great. Okay. So, by the way, what is a deferred sales trust? I'm talking about these bigger ideas. Let me just dive into exactly what it is. It's an installment sale that's coupled with a trust. And so if Anna were selling, let's say, a $10 million multifamily property in San Jose, California, and she's owned it for 27 and a half years, it's free and clear. She's fully depreciated. If she were to sell that, it'd be subject to about a 40% tax. State, federal, Obamacare, some depreciation recapture, could be more as well, but we'll use 40. So instead of paying that tax, she can really do a couple things. She can do a 1031 exchange where she could have all of the 10 million go into a qualified intermediary where it's third party, unrelated to her, and she's not taking what's called constructive receipt, or she's not taking any cash at closing. That's going to defer that tax as long as she buys another like kind property, right, within 180 days of the closing, and she identified that within 45. That's the rules you have to follow in the 1031. By the way, same thing with the Delaware statutory trust, right? You send it to a qualified intermediary, and it typically goes to a third-party commercial real estate operator. And sometimes it's multiple properties, sometimes it's just one property, but it's the section of the 1031 exchange of the IRS tax code that allows that deferral. Well, the deferred sales trust is different in that it uses a different tax called 453, which is an installment sale. And so Anna could also just finance a buyer. Anna may find a buyer from Fremont and they're like, hey, I want to buy your property for 10 million. And she says, great, we make a deal. They go, but Anna, I want you to finance it. Would you finance it for me? And she could say, sure, that's no problem. And they give her a $3 million down payment, and she finances $7 million. That's known as an installment sale. Now on that first 3, she's paying tax. On the other 7, she's deferred, right? It's tax deferred. She hasn't received it yet. But now let me bring this whole thing together, right? The deferred sales trust is coupling that installment sale with the trust, but we're going to ask that buyer from Fremont to not, we're not going to finance them. We're going to ask them to come with all cash or get a loan from a bank. And instead of financing that buyer, she's going to finance the trust. And she's typically going to finance the trust 100%. And she's going to allow the trust to ultimately sell it to the buyer. And by doing it in that order, she's in a opportunity to earn somewhere between 6 and 9% interest rate. She hasn't received any constructive receipt at closing, and she has a promissory note that's owed to her from a trust. The buyer takes title, he's gone, and now she's in a position which is liquid and diversified with the funds. And there's also typically no debt replacement requirement. How many of you know there's a lot of people in a lot of trouble? I saw Neil speak at the Best Ever Conference about those who overpaid for properties in a short time frame with the 1031, took on too much debt, over leveraged, and now these rate caps are expiring. And guess what? They didn't have an effective capital gains tax exit plan. In fact, they didn't even have probably an effective debt plan. because now they're going to lose some of these properties to the banks, right? And I remember I just had Neil on my podcast about a month and a half ago. We were talking about this, and one of the biggest things he said was, we didn't buy the last 12, 18 months, for the most part, maybe one property or so, because these properties didn't fundamentally make sense mathematically. And so when we're looking at the deferred sales trust, we want to take that same tax flow mindset of, it's not just cash flow, it's not just tax flow, it's also debt flow or debt structuring. And the beauty of the deferred sales trust is there's typically no debt replacement requirement, unless you have some debt over basis. And then we'll talk about that using a Delaware to solve some of that statutory trust. But that's so important, right? Right now, we believe it's the best time to be out of debt, to be diversified, to be liquid. That is the definition of an effective exit plan. Why? So that you can take advantage of opportunities when they make sense for you. The real estate market in 2008, did you know that it took 3 years before the values really tanked to the bottom of the market? In other words, real estate takes a little longer, quite a bit longer than, liquid investments, right? To really, falter. And so these opportunities that are coming up may take some time. And where the 1031 fails is you don't have that liquidity, the diversification. You don't have the ability to go in when it makes sense. And so that leads into the next one, the ability to partner with the DST to purchase a new property at any time. So I want to tell you a story on this one, and this is what helped me to become a believer in what I'm talking about today. It's a gentleman who sold an asset in 2006. So I started out in a real estate industry in Fremont, Mission, San Jose. I keep mentioning that, Silicon Valley, helping my parents build and buy properties and cash flows since a young age. And so I fell in love with real estate, and then I had a chance to study and practice an internship at a place called Marcus and Millichap, where I helped my clients buy and sell properties in 1031 exchange. And things were going well for a little while. And then the 2008 crash hit, and we saw friends, family, and clients lose half or everything. And the biggest thing we found out was too much debt, not enough liquidity, not enough diversification. And the reason is because they did these 1031s where they ran out of time to purchase a property that made sense, and they just pushed it through. And then they ended up in a poor position. And so this gentleman in 2006, I didn't learn about this 2009, he sold at the peak, and he looked around for his 1031 binoculars, and he said, none of these properties make sense. He sold a $20 million asset, and he parked the funds into the deferred sales trust, and he deferred the tax, and he waited 5 years. And the property he sold for 20 million, bank called him back up 5 years later and said, hey, we just foreclosed on the property. We're curious, do you want to buy it back? He says, well, maybe. What's the price? And they said, well, 60 cents on the dollar. He said, 40% less than what I had sold it for. And they said, yes. He says, that sounds like a pretty good deal. Give me a couple days. The deferred sales trust partnered with him, put up the capital, all tax deferred, to buy the property back with a fresh depreciation schedule, which he gets 80% of, all tax deferred. And at this point, I'm sitting in Marcus and Millichap thinking that we were the Navy SEALs of investment real estate and 1031 exchanges, and we were going to school. And unfortunately, we were a couple years too late because the market had crashed. And so this began the journey of fascination of just wanting to learn and absorb, not having to have my clients go through the pain of 08 ever again, and not having to feel trapped with your time, your energy, and the location freedom with the 1031 exchange. And so these deferred sales trust installment sales are typically 10-year terms. They can renew every 10 years, and they can partner with you on anything. Basically, that's investment or business purpose. And so essentially what the deferred sales trust helps you to do is unlock what we call 10 freedoms. And these 10 freedoms, we believe, is what is the foundation of a not only financial, but also a personal, effective capital gains tax exit plan. I mentioned some of them before, but I think it's worth mentioning again. These freedoms include time, energy, focus, right? When you have more time, you have more focus. I just helped a client in Sacramento sell a $2.5 million property. For that one, Warren and Catherine were the clients. They actually had done a 1031 exchange out of Manhattan Beach. They had two daughters a little bit later in their life, but twin daughters that were 10 years old. And Warren was telling his story about the deferred sales trust. And I said, you had a lot of toilets, trash, and termites, right? And he goes, yeah. I go, what's the biggest thing for the deferred sales trust that helped you with your time? He goes, well, I found myself trading my 2 T's, which are my twin daughters, right, for the other 3 T's, toilets, trash, termites. And so he's driving a couple hours, every other weekend, fighting traffic to take care of the property. And he's going, what am I doing? I've got, multiple millions now. We're doing great. Why are we spending all of our time and energy when I could be spending with my daughters? And to us, that's the type of freedom and the impact that he can have right now and not have to feel trapped by the capital gains tax. So that's the kind of thing we're talking about here. Location freedom. Again, we had a client who sold an asset in Palo Alto, moved to Nevada, established residency. You know, he wanted to move closer to family. Retirement. We've had clients sell businesses. One just recently in Colorado, and they've been in this business for 30 years. It was a C Corp, subject to massive tax on C Corps, and we were able to defer the tax and get retirement. Entrepreneurial freedom. We'll tell you about some clients here who sold businesses and then are developing commercial real estate here in a minute. But of course, 1031 exchange, debt tax, diversification, liquidity, debt, partnership, optimal timing, cash flow. Now, other strategies provide some of these things, but the deferred sales trust, we believe, is the most effective in the times like this because it does all of these things and it's flexible without throughout the process. We talked about the already unlocking the capital to invest into real estate, and we also help and coach and teach people how to do this. Okay, so that being said, let's keep continuing on here. If you want to take a picture of this, this is just a quick snapshot of what the deferred sales trust benefits can do. Already talked about a number of them, but I'll give you like 10 seconds to take a picture there. But as well, you will have the slides as after the presentation. Here's another one as well. I say us versus them, but by the way, I love 1031 exchanges. I'm a broker. We'll still do 1031 exchanges forever as long as they're around. But when they're restrictive and they don't serve our clients' best interest and what they really desire, then we're not a big fan of them, right? We want people to have options to do both. And by the way, the deferred sales trust, you can do a partial 1031 exchange and a partial deferred sales trust. We helped Susan in Colorado who sold a multifamily property and she wanted to do a partial Delaware. So we did about 20% into the Delaware statutory trust, which is another form of 1031, and then 80% into the deferred sales trust to give her some diversification within that. So it's not always a one size fits all. And sometimes, by the way, there's a debt over basis challenge. So I promised I would share how we solve that. We do that with a Delaware statutory trust. And so let's do a deal that we did recently. And by the way, one of the Achilles heels of the deferred sales trust is it cannot defer income tax. It cannot defer debt over basis. So if Anna, we'll go back to Anna's story. So imagine Anna had a $10 million property in San Jose, fully depreciated, but she had a cash out refi of $3 million. And so her debt is $3 million over that basis, which is zero, right? Well, that's considered ordinary income tax if she sells it and doesn't replace the debt over basis, right? So that's a challenge that the deferred sales trust cannot solve for. So that's where we bring in the Delaware statutory trust and we solve that challenge. Typically, these are Amazon coupon deals that are zero coupons or FedEx, so they are the tenants. And so it's nice because the debt goes on, they're non-recourse, and it goes on the property or a big operator who's operating that. So you get the benefits of replacing the debt, deferring the income tax. But at the same time, Anna in this situation could be very flexible and nimble because now she's out of debt, she's diversified, she's tax deferred, and she gets all of the ability of all assets of any kind she can purchase. Anytime she can invest into them. And she could also move it outside her taxable estate. She could have that liquidity, and she could have that new depreciation schedule. So we'll keep going here. Here's a recent conference we were at, but there's a couple deal stories. So how many of you are general partners or even limited partners? Okay, if you're a general partner, and that would be like Anna and Neil, and what they do, they structure syndications. Well, this is David Sloan. He used the deferred sales trust to exit 5 exits and defer 100% of his capital gains tax. And so his biggest thing was every time he would exit, they wouldn't do 1031 exchanges. They would just pay the tax. Now they could also invest into certain things and get cost segregation on, but sometimes they didn't line up on that. And that bonus depreciation is, it's at 100% last year, 80% now. It's going down every year, and we'll see if they renew that. Hopefully they do. But the point was, he's going, Brett, I'm paying way too much in tax. He lives in Southern California. He goes, we're exiting 3 to 5 deals a year, and I'd like to just put my GP interest in there. Can I do that? And the answer is yes. In other words, with the deferred sales trust, it works for GP interest or LP interest. He's also had an LP come into it recently. And it doesn't have to all go into the same account. It's separate accounts for each individual investor or family. And he can move it right back in to the next deal, the way we structure it all. So he has an extra about 40% per exit. And so he's done it for 5 exits. The most recent one on the right side was a $48 million exit. You can watch this whole story on my YouTube channel too. This is Dave Levinson. So the DST, he said a quote I think was so wise, and I agree with him. The DST was created for times like this. and it saved Dave's 1031 exchange. But the bigger picture wasn't just financial. Dave has done hundreds of transactions over the years. He's actually originally or spent a lot of time in Hawaii, over 20 years in Kona. Okay. And so he sold a lot of properties. He ended up 1031 exchanging. He's in California now, but he ended up buying a property out in Athens, Georgia. Did a great job of improving it, sold it for a huge gain, and was faced with a lot of tax and also a lot of debt. And COVID hit, and he was like a lot of people, like, I don't want to chase I don't want to catch a falling knife. I don't want to chase a deal with bad debt. And I really actually want to spend time and energy in Montana, building a leadership corporate retreat to encourage and build leaders in the corporate world. And so he decided to do a deferred sales trust. It saved his 1031 exchange. You can hear his whole story on YouTube. Here's an entrepreneurial client. So if you say, hey, Brett, I'm still very entrepreneurial. Can I buy and sell deals with the trust? Can I do different things? Because it work for short-term or long-term? Well, this is Dharma. He is a commercial real estate syndicator. He's also like a land developer, and he used it for about 37 million in land exits alone in Texas last year. But it also was short-term. So he would tie up the land, and how many of you know that a 1031 exchange only works if you've held a property for more than a year? Whereas the deferred sales trust, we say it's like Netflix versus the blockbuster, 1031, because it works for short-term and long-term, and it's more flexible, right? So he used it for exits where he would tie up the land. He wouldn't close on the land. He would improve the land over a period of time. He would find a buyer. Then he would close it all in one escrow, and it would be short-term ordinary income tax, but he was able to use the deferred sales trust to defer that, okay? Just a couple more here, and then we'll kind of wrap it up after that. But this is Stormy, and she and her husband Jeremy. They had an Airbnb property that got, like, the whole neighborhood got like rezoned, or not rezoned, but restrictions on the Airbnb. So they bought it as a rental to Airbnb. All of a sudden it fell apart. So they sold it, used the deferred sales trust, and then they used the deferred sales trust to partner to buy another Airbnb in Arizona. And so they're really happy about that. We recently did a deal in Sacramento. It's a billboard sale. And this is Jeff Joaquin, and he, it's like the digital billboards. If you see those, they're probably his, anywhere kind of in California, especially. And if you've been to Arco Arena, or not Arco Arena, I'm sorry, the Golden One Arena, the new one, he's all the billboards out there, all the digital billboards, pretty cool stuff. So he sold. His biggest thing was he wanted to not unlock his time freedom, but he wanted to travel more. He wants to move out of California, but he wasn't looking forward to paying 40% in capital gains tax. And so he used the deferred sales trust to defer all of that. And this is I think one of my favorite clients, just a great person, and an amazing, he's become a friend. But for Shay, he sold a business. And when he sold the business, he had an entrepreneurial dream. And his dream was to start building and syndicating multifamily properties. And so he used the business sale out of Alabama to fund his Tennessee multifamily 70-unit project. He's just finishing up the project now, selling the units, moving the funds back into the deferred sales trust. This is Ron Anderson. He and his wife out of Colorado sold about a $4.2 million multifamily property. And this is an Airbnb, but for him, it was going so well. I mean, how many of you have an Airbnb property that just goes so well, but it's just taking up the time and the energy? It's making all kinds of cash flow. Well, that was them. They're like, oh my gosh, this is going so well. Let's just sell it. It's just taking up too much of our time and energy. And they sold it, deferred the tax. Very happy about that. This is Steve Prince. We saved his 1031 exchange. This is a property on S Street in Sacramento, California. I helped him sell that, structured the exit, and he was able to separate a partnership, as well as because in a 1031 exchange, how many of you know that the whole exchange must go? Meaning, typically all the partners must go to the next one. Which one of his partner here, John, had a family emergency, needed the capital, so he kind of left Steve at the altar, about to get married to another deal, and that, all of a sudden he doesn't have half the cash, he can't close on it, and so this saved not only the 1031 exchange, but it also saved the partnership. And the list goes on and on and on. Denver, Colorado, Saratoga, California, San Diego, Monterey, Primary Homes, Cupertino. It also, and here come Anna, you're coming up here in a second. Also works for Bitcoin and Ethereum. Okay. Bitcoin and Ethereum. So we did 12.5 million of exit before the Bitcoin and Ethereum crash here, for clients that used to work for Ripple and Google, really smart, sophisticated folks who exited and deferred the tax. And that being said, I'm going to pass it over to Anna. Anna, would you like me to stop sharing my screen so you can share yours?
Yes, please.
Okay.
All right. That is some pretty exciting stuff. I'm telling you, I'm learning so much. But I just want to take a few minutes to share a really late stage opportunity. It's a build to rent new construction syndication. And this one's a pretty rare opportunity because you get to jump into the project within 9 months of the project delivering 25% of its units because you're coming in phase 2. So this is the design. They're basically 2-story townhomes. They've got really open floor plans. They're well diversified. We've got 2 bedrooms, 3 bedrooms, a sprinkling of 4 bedrooms. So there's a swimming pool. You can see it back there in the corner. There's a playground area, a beautiful central grass area, and there's a beautiful clubhouse. But one of the best amenities that these tenants will have is the location. So you can see it's in this great location. It's in New Braunfels, Texas, by the way, which is an awesome place. We'll talk about that in a minute. But the site is nestled between Mission Hill Park, which is this beautiful park, and then on the other side is West Point Village, which is a shopping center that's got basically everything you can want: grocery, retail shopping, fitness, medical, banking options. It's all right across the street. And plus, all of this is just 10 minutes away from the Highway 46, which gets you to the Austin-San Antonio corridor. And lucky you, we are in an extremely late stage of the project. Basically, a small set of phase 1 investors, along with Grow Capitus funding, Neil and my money, that's what's gotten the project all the way to this point. So at this point, you can see there's no zoning, no approvals or entitlement challenges. The remaining civil construction and building permits are under review and expected to be delivered in the next 60 to 90 days. And yes, that is huge bulldozers moving dirt. So we're already well under civil construction, massive amounts of dirt being moved, and the terracing that's happening on the site. And if you didn't catch it in the beginning, this project is in the hottest and fastest growing segment in all of real estate, build to rent. It caught fire over COVID, and really everybody they can't get over it. You have potential home buyers who are basically priced out of the market, and they love BTR because it's kind of the next best thing to home ownership. And build to rent tenants, they stay longer because they pay more. And so it's basically, at this point, it defaults less than any other segment. And let's go back to San Antonio, New Braunfels. This market, we know how to pick markets. This market is one of the hottest real estate markets for 2023 in the US. Out of the entire US, it is number 12 in the US. And there's a lot of markets in the US, so that's really saying something. But even better, Urban Land Institute, ULI report, places San Antonio, New Braunfels as the number 1 for home building prospects in 2023. Guess what we're doing? Building homes in San Antonio, New Braunfels. And many of you might be wondering about, those interest rates. Well, guess what? We have an absolutely amazing construction loan. We were able to lock in an ultra low interest only 4% fixed rate. So that is our current construction loan that we're operating under. And for phase 2, we believe our timing is actually good because as we continue to build on our existing construction loan, we're thinking that the Fed in the next 5 to 6 months, they're going to the interest rates will start going down. What we really need is that risk margin to start going down. So as the spread falls, we expect to get better results. But we did not put that into our underwriting. Our underwriting is still very conservative for our interest rates. So here's a quick look at the investment classes for Equinox. We've got a plethora of diverse choices for you. We've got Class P at the bottom with a projected 2-year hold for those that are just in for a little while. And then you've got 12% preferred return, but you don't get any back-end profits on that one. But it does have depreciation, which is not all the time available for a pref class, and you have cash flow starting at the end of this year. Class B1, B2, B3, there's a projected 4-year hold and projected IRRs of 20 to 21.5. Now you can combine Class P and Class B, and that is an opportunity for you as well. So if you're interested to find out more, I definitely recommend, I'll put these links in the chat, to go to growcapitus.com/EXNB-kit and set up a call with Andrew. He'll walk you through the project. It's best to watch the webinar and kind of dig into it first. But Andrew is there to answer all your questions and help you get set up. And with that, we're going to get back to learning about how to avoid paying capital gains.
Awesome. Thanks, Anna. It looks like an amazing project.
Yeah, we're super excited about it.
Double check you can see the screen here.
Yes.
Through how this works. Anna, do you want to participate? Are you ready?
Yes, I am ready.
Okay, we're gonna get down to the how this thing works. We're talking about a lot of the big ideas here. We're gonna get real practical here. So, Anna, by the way, we could use. You want to use that? I mean, I'm just throwing out the 10 million San Jose property as an example.
Yes, but we don't invest in California. But sure.
Because someone might be listening who has, right, and is waiting.
Yeah, of course. And you know,
that.
property's gone up a lot in California. So sure, if we bought something in San Jose a while ago, it would be worth a mint. Yes.
Yeah, and imagine they have that $10 million asset. That's the return on equity, by the way, is 2 or 3%, and they're going, gosh, I just wish I could sell it and I could invest into something that's like a 26% IRR over a few years,
right?
And I don't have to do all the work, and I can trust it with Anna and Neil and the team. And wow, is there a way to actually exponentially grow my wealth without having to do all the work, but still say tax deferred? And that's what we're talking about. That's absolutely what you can do. And this is the beauty of the deferred sales trust. And so let's walk about how this would work. And in fact, let's apply it to the San Antonio deal with Anna. So Anna, you ready?
I am.
All right. So Anna, you have this $10 million property. It's in California, let's just say, and we're going to use a zero basis. We're going to put that down here. And to keep it simple, we're going to use zero debt. Okay. We're going to put that down here on the left. And
okay.
So we're looking at, about 40%. And people say, how do you get to 40? Well, federal is 20% when you get to these numbers. State of California is about 13.3, although they're actually proposing potentially go to like 16, I think 0.4 or 16.8. And then you have Obamacare or Medicare tax of 3.8. And then you have depreciation recapture. So that's how I'm getting to 40%, in case you're wondering. But we're going to keep it simple. It's going to be $4 million of tax. So Anna, if you do nothing, you're going to pay $4 million of tax. And I'm assuming you would like to defer that. Is that correct?
I would love to defer that. Thank you. How can you help me?
All right. So the first thing we're going to do is we're going to sell it to the trust. And we have this buyer lined up. You find an amazing broker or whatever. You find a buyer for 10 million. But Anna, check this out. If you were to sell and the buyer were to give you the cash directly, right? So you take 10 million in your hands. Do you see how this 4 million would be triggered, right? Because you took the 10 million, right?
Yes, it would.
So we're not going to do that. What we're going to do is we're going to have this trust jump in right in between you and the buyer. And if the trust buys it for 10 million, right before it sells it to the cash buyer, by the way, they can get a loan, doesn't matter, for 10 million. How much gain does the trust have if it bought and sold for the same price?
I would guess 0.
You got it. You guessed right. 0. And this is not a great 10, but
yeah,
but
it's okay. We understand.
We got it right. Good. Now, if the buyer puts the 10 million into the trust, okay, and it gives you a promissory note, meaning what you receive is a promissory note here, right? And it goes down in this arrow here. That's what you get. You did an installment sale where you carried back 100% financing, and you get this promissory note for 10 million. So you became the lender or the bank. And let's just say this promissory note's at 8%. Okay. But you receive 0 at close of escrow, Anna. How much tax do you owe on 0? How much is triggered on 0 if you receive 0 today?
I'm going to guess 0.
You got it. Okay. And so it's still owed, but it's over here. Okay. I mean, the 10 million's here, but it's in a deferral state. By the way, this is like a 1031 exchange company, right? Think of it. It's kind of like that. Right?
Yeah.
It's deferring.
Yeah. That's what it looks like. Yeah.
Yeah. You got it. So any questions on what just happened, Anna, on this page? Because this is really important.
The promissory note is coming from the buyer. That's my question.
It's coming from the trust.
It's coming from the trust. Okay. So the trust is paying me 8%. So I guess maybe that the next step will be, my question is going, what happens if I then spend $5 million on buying something? I find something, 9 months later.
Yeah. Great question.
Okay.
So let's answer it in 2 parts. Let's imagine of this 10 million, right? You say, I just want $1 million to spend on my primary home, my business, whatever. Or I would say business, but we can defer that. but on my boat, my whatever, right? You could pay the $1 million of tax there. You'd pay about $400,000 to get it out, right? 40%. But you could then this note would be for 9 million, right? So that's just a sample. So you can always spend whatever you want. It's your money, but you can defer all in part. But let's just focus on your question now. And by the way, I'm gonna do it one more time so everyone caught this, right? Instead of Anna selling directly to the cash buyer and receiving constructor receipt and paying this $4 million, she's gonna do an installment sale with the trust. The trust is gonna buy the asset from Anna but Anna's going to finance the trust 100%. So it buys it for 10 million, sells it for 10 million, which means there's no gain at the trust level. The buyer takes title of the property, buys it from the trust, and they're gone. And Anna's left with a promissory note. In other words, she became the bank. She is the lender to the trust. Okay. Now the trust, the promissory note, right? That she's the owner of. She owns the promissory note. Is typically written at 8% compounding interest rate, depending on her risk tolerance. It could be lower, 5 to 9 is kind of the range. And she doesn't pay tax until she receives payments from the trust. So it's kind of like an IRA or a 401k in this respect, right? If she would have put this, let's say this is a retirement account, the income and the capital gains tax can build up inside of the trust in a very efficient way. Now, she might say, you know what, I think I'm going to move to Texas or Florida or Nevada,
or Washington,
and I'm going to establish residency there. And what's really unique about the deferred sales trust is she might delay the payment for a couple of years or a year or 6 months or whatever, and then establish a residency in a new year in a new state and start to receive that 8%, which would be $800,000. That would be ordinary income tax. Okay. But it's only in the state that she's in. So this is a really efficient way to get sort of, we call it tax flow engineering, to be in a more favorable receipt. Any questions on that, Anna, or are you ready for me to talk about the investments?
Well, I do have Greg asking, he's not quite clear. If an owner sells to the trust, why isn't there any gain on that part of the transaction?
Yeah, so there is a gain. It's just deferred. And great question, by the way. It's deferred sort of like a 1031 exchange, right? It's still a gain. It's just locked in and deferred until the owner stops doing a 1031 exchange. And so it's look up constructive receipt. Constructive receipt is taking cash at closing into your personal account. In this scenario, this trust is taking the money. Anna doesn't own the trust. If she owned the trust, it'd be taxable. She's selling it to a third-party trust, of which our company is a trustee for. But it's sort of like she put it into a third-party qualified intermediary, right? In other words, you're delaying, or a third-party IRA company, you're delaying taking constructive receipt of the cash so that it can grow and build. Another question might be, why would the government allow this? Well, A, it's getting money moving and flowing. It's a study of macroeconomics, which actually creates more tax revenue because Anna is going to invest this money and it's going to perhaps create more jobs, create more tax revenue for them. There's new property tax assessed on the California side. There's commissions paid. So the government really wins there. So Anna, do you think I answered the question there, or should I clarify that more?
Yeah, no, I think we're good. And we've got, I think you're close to wrapping up because we've got a bunch of questions.
Yeah. So let me go ahead and just clear this here and answer that one question. I think it's so important on the investment. I want to tie this into your guys' deal in San Antonio, right? So Anna, you go, look, I got an amazing deal in San Antonio. There's 10 million in this trust. And you're like, I want to invest it into this deal that's paying, I'll just do 20% to keep it simple. Okay. You can form, Anna, an LLC. Okay. And you can do what's called a joint venture partnership with the LLC. And 5 million can go to this LLC, where Anna has 80% ownership. The trust puts up all of the money for 20% ownership, and typically an 8% pref. But remember, the trust owes you the money, the 10 million at 8%, right?
Right. So it's kind of a wash.
So it's kind of a wash, right? Now, this is the neat part. Anna, you put no money into this part, but you are the active GP. You are the active investor. You have the deal lined up, and it goes right into, let's say, the San Antonio, Texas deal. So remember, you would have had 4 million of tax up here. So do you see how this kind of like this 4 million is in this deal, all tax deferred, without a 1031?
Yeah. And what's interesting is you don't have to involve a lender when you're trying to 1031 into a syndication. You're saying that you can invest as a, effectively come in as a limited partner on a deal, and it doesn't matter that it's a new construction deal, or you don't have to do a build to construct 1031. It's very elegant, Brett.
Thank you. And we'll add one other thing to this I think you'll like. Would you like a new depreciation schedule or an old one?
I'd like a new one, please.
Okay. So you're going to get a new one here. And now you're going to get 80% because we've got to make it what's called commercially reasonable. Okay.
Yes, that makes sense.
Yeah, the trust does take 20. It doesn't need it. If it, now we might structure it in a way where if you put actually some money in, you could probably push that a little higher. But let's imagine you did some cost seg on this deal over here, right? And by the way, this $5 million might leverage up to, I don't know, $15 million worth of purchase power, right? And that 15 million is a new depreciation schedule, right? Which could flow through to the LLC, which could flow through the owner you as 80%. So that's just a quick little snapshot where, you're an owner. So someone might say, well, I don't want to just be, locked in at 8% as a lender, right? Well, great. Well, then why don't we do a joint venture LLC and you can make even more return? And you go, well, I don't want to give up 20%. By the way, you're not giving up the 20%. It's still owed back to the trust.
Right.
Okay. Until it pays the 8% pref. But Anna could also purchase an option to carve out if she felt like this deal was going to do, 20 is actually a pretty good number to purchase an option on. She could purchase the option and get up to 98% of the upside after the trust pays back the original 5 million, or after the Texas deal pays back the original 5 million, it pays back the trust to pay her. She could carve out up to 98% of the upside as a one-time option. So these are things that we execute. I know we don't have much time to go into all that, but I just want to tell you what's possible. The funds can also go into stocks, bonds, mutual funds. It can go into hard money lending. It can sit in T-bills. We typically are looking for like a diversified portfolio of investments based upon your risk tolerance. We work with third-party financial advisors. Funds are typically held like a Charles Schwab, TD Ameritrade, Raymond James. There's lifetime audit defense that's provided for every case. So let's keep going here because I know we're sake of time. A little bit about us. We believe that we're in a fight for, we call it the good fight for freedom, right? Over the next 20 years, the largest wealth transfer in the history of the planet's happening. It's $84 trillion, according to Marcus and Millichap, it's the latest stat. And that's a part of the baby boomers, 77 million in the US alone. And there's 10,000 turning 65 every single day. 50% of the total net worth in America is high-end primary homes, businesses, and commercial real estate. And a lot of these assets are going to be exited in the next, number of years. And so what we really are fighting for is where that 84 trillion is going to be. Is it going to be in the hands of the people who created it and to be able to, build housing and do the things that are so needed and create jobs? Or is it going to be in the hand of the government, which maybe we can all agree that no matter what side you vote for, they're not very efficient with the spending of that money. And so our purpose and our calling is to help not only families get the freedom with the capital, but also to make an impact. Right? To build a strategy and a team to unlock the freedoms, not only for themselves and their families, but also housing, right? Housing is 4 to 5 million units short in the US alone, right? And so if this $84 trillion can be unlocked out of cryptocurrency, stock, businesses, primary homes, commercial real estate, the example we use for an apartment complex sitting in, San Jose, California, and they don't want to sell it, but it could be unlocked to fund the construction of development in Texas for more housing, right? These are the types of things that we're really passionate about, and it's making an impact to be invested in families and communities. But our big, hairy, audacious goal is to become a Fortune 1000 company through achieving our mission, which is to basically impact 1 million lives by providing 100,000 capital gains and estate tax solutions. The way that we're set to do this is to lead and inspire the building of wealth and freedom with our clients and strategic alliances like Neil and Anna and Grow Capitus through the relentless execution of these strategies. And this is, I think, a big moment for anyone who's listening to this. This is our flywheel. It all starts with you, the owner, the client, the investor who's built the business, the wealth, has had the primary home, has the cryptocurrency, and is feeling stuck or a little bit trapped by that capital gains tax and wants to unlock it without having to be tied into, and opportunity zones are great, but not having to be tied illiquid for 10 years, or not having to be forced into a 1031 property of equal greater value, or equal greater debt, or having to go with the Delaware Statutory Trust, which also gives up all control, liquidity, diversification. They all have their place, but we believe the deferred sales trust is the centerpiece, the cornerstone for clients to have that effective and freedom capital gains tax plan. Also eliminated that estate tax. Once you eliminate the estate tax, not only on the exit of the asset, all of the growth is also outside of your taxable estate, which eliminates that 40% estate tax. And then it invests into real estate, securities, and businesses, which creates more jobs, right? And that ultimately creates more freedom. Some of our core values is we really focus on every single day and every way we get a little bit better. Part of that is working in joint venture partnering and strategically aligning with amazing groups like Grow Capitus, and who have a passion for making a difference and an impact. This is a little bit about myself and my family. I'm a father, husband, CEO, and author. In fact, I'm also a broker, a multifamily broker. I've closed over $500 million in commercial real estate and deferred sale trust transactions. I'm also one of the few that have closed all three of the real main ones we talked about today, which is a 1031 exchange, Delaware statutory trust, or Delaware 1031, and a deferred sales trust. My wife and I almost married 14 years. We have five children, 4 daughters and a boy. I grew up playing basketball, mostly in Sacramento area, but I'm originally from like the Bay Area, Silicon Valley. I now live in St. Augustine with my family. We just moved out there 5 months ago. We have our second home in Roseville, where I'm at right now. And if anyone likes basketball, I'm a huge, I played basketball in college, scholarship at a small private school. I love basketball. I'm a huge 49er fan, Duke basketball fan. So that's a little bit about me. By the way, that book too, you can check out Building a Capital Gains Tax Exit Plan. Neil is in the book as well, has an amazing chapter, and others are in the book that talk about the journey of all of this. And so you can check out the book on Amazon right now. It's a #1 bestseller, which is pretty cool. We have like Kevin Harrington from Shark Tank in the book, which is pretty awesome. We have Tony Robbins, CPA, in the book, and a few other really, really smart people. And so that's it. With that, I'm going to open up for questions. This is my contact information. If you want to contact me or one of my team members, we're happy to schedule a call. Here's the key. It needs to be a $1 million net proceeds, $1 million gain per transaction, unless you have 2 at $500,000 each. Our fees are about 1.5% on the gross sales price as a one-time fee. And on the first million, 1.25 on anything above that. That covers lifetime audit defense for the trust. My fee, ongoing fee, so the tax attorney, that's my business partner, that's what he gets paid. As a trustee, the financial advisor, we're typically around 1.5 to 2% on a recurring basis year in and year out, but we're typically able to earn net of fees, 6 to 9% compounding on the funds that go into the trust itself. And so I'm happy to go and show you our fee schedule and all of that. That being said, let's open it up for questions. And Anna, you want to take it away?
Yes, and you definitely hit some of those, saying, what are the fees? So we just went over that. Let's see, if the buyer fails the DST contract, does the asset return to the seller?
Okay, great question. Yeah, so it's a simultaneous close, right? So we're not transacting unless the buyer actually performs. So the way we work is a conditional basis. We will plan, we will form the trust, we will talk to your CPA, we'll do all of it, literally 99% of the work, or just about all the work. If the buyer doesn't perform, or for some reason you decide to do a 1031 exchange, right? Or you decide not to use the DST, no hard feelings. You don't owe us anything. We take all that pressure off the table here. We don't want to make this a sales thing. We really want to make it an effective plan for you that you can execute when it makes sense. So if that buyer pulls out, no problem. If you pull out, no problem, really no problem. We'll be there maybe for the next one. But that's how that would work. It would just, go back to you. There would be no sale and you would maintain ownership. So it's not like you're selling and just waiting around for the trust to sell it. It happens in a simultaneous close.
Okay, I've got some great questions for you. Are you ready to roll?
I'm ready to rock and roll. Let's do it.
Okay, all right. When does the trust end? That's the first question. When does the trust end?
Yeah, so it all depends. So most of our clients like to pay the tax the second day to never. So what does that mean? That means they're typically just living off the interest, and these are 10-year increments, and every 10 years they can renew and pass it to children. On the DST Plus or DST 2.0, which we touched on, it has to do with estate tax. The children are the beneficiaries, and they can inherit it outside of the taxable estate. And so it could potentially end there or just keep going. Depends on the living trust and how you're setting this up. Part of the way that we focus on how we help our clients is creating like a family office environment for our clients, where we have experts in all the fields. And so, number 2 could be you want to get out early, right? You want to go spend it on it's your money, right? We can unwind the trust. We can also set them up in not 10-year increments, but 5-year increments or 2-year increments or 1-year increment, meaning the balloon payments due at the end of that 1 year, and it's by default going to end. But the trust can be unwound. You can pay your tax depending on, how we structure the deal. So hopefully that answers the question there.
Okay. Let's see. So I think, did you just cover what happens at death? Does your family have ownership now of the trust?
So it depends on which trust we use. So at the DST 2.0 or the plus, which is typically reserved for 10 or 20 or $30 million deals, your kids can be the beneficiaries. Okay. So if you were the beneficiary or the owner of the trust during your lifetime, it's taxable. Okay. So your children can be the beneficiary. So on that one, yes. Okay. On the DST 1.0, they can step into your shoes. It's just a promissory note using IRC 453. You might say, well, when do you do one or the other? Well, one of them is the DST 1.0 is more flexible for the payments, turning on and turning off, and kind of real flexible. And that's typically reserved for $5 or $10 million deals and below, depending if you're married or single. There's a thing on IRC 453 where if you are, if it's greater than 5 million and you're single, then it's subject to an interest charge. And that's when we entered the DST 2.0. But a lot of our clients, sometimes if they're ultra high net worth, they're going to do a 2.0 and a 1.0, depending on the flexibilities that they want. But your children can step into your shoes, right, with the 1.0 and continue the tax deferral. The 1031 exchange does have a stepped up basis. But guess what? It doesn't have a new depreciation schedule. So we will do that ROI with you too. Like with the Anna deal we're talking about, is it better for her to wait and never sell that versus, and let's say they're doing 3 to 4% ROE versus going to get 26% ROE now, right? Plus that new depreciation schedule during that lifetime, we think we're going to make much more wealth than just holding on for the stepped up basis. But the 1031 exchange does maintain the stepped up basis. The DST 2.0, the other, part of that is it does pass capital gains tax free because part of the payment during the lifetime is subject to capital gains tax and some interest ordinary income. It's a mixture based upon your life expectancy. And so that's why sometimes we're using one or the other. So I think what you're quickly going to figure out that it all depends. It all depends on what you're trying to achieve, how much money you're planning to spend. We might even mix in a donor advised fund. We might even mix in, a foundation or some sort. We're going to plan and give you your options and then figure out which one's the best. Again, the DST is not a one size fits all, but oftentimes for the entrepreneurial client, for the real estate client who wants flexibility or investor, it becomes the cornerstone type of strategy. So hopefully that answers the question, Anna.
Yes, I think so. We've got about 5 more minutes. So I've got some good ones for you. You ready? We're going to slice through them. How are those funds protected in the DST?
Yeah, so great question. So first thing is we use third-party financial advisors and some of the biggest, institutions in the world: TD Ameritrade, Charles Schwab, Raymond James, to custody the funds. Okay. And so as a part of that, we also use third-party banks. The funds never move without your signature or your approval. And so that's the first thing. There's multiple eyes and ears. We also have third-party tax preparers, actually out of Morgan Hill we use, and San Jose area, if you don't know where that's at. And they are doing the tax returns for the trust, which you have access to, and they're looking for anything that's inconsistent. As the trustee, these trusts are never commingled in a personal account or business account or other trust accounts. They're single entity trusts that only do business with you, or if you're married, you and your spouse. And then also you can partner with the trust to do your own deal. So there's lots of eyes and ears on this to keep the transparency and the accountability and the protection of the funds. So, but most of our clients like to go into real estate, and they're partnering with groups like Neil and Anna and Grow Capitus, and they're investing there, and that's where a lot of the funds are at. So hopefully that answers the question, Anna.
Yep. After you created a deferred sales trust, do you have to continue to be a U.S. resident for the DST to continue to be valid?
No, you don't. In fact, if you're not a U.S. resident, it's even more valuable. And let me tell you why. That estate tax exemption, if you're not a U.S. citizen, but you have capital in the U.S., you don't get any of that exemption. So for example, let's say you're Singapore is your country, but you made a lot of money in the U.S. Upon your death, the U.S. will still take 40%. Okay, 40%. It's brutal. So let's say you're worth $100 million and you live in another country. They're going to take 40% of the 100 million. In other words, you have no exemption amount at all. In fact, I think it's like 64,000 or 68,000. It's a small amount. So it's even more important if you are not a U.S. citizen to consider the Deferred Sales Trust Plus for that reason alone. But let's say you are a U.S. citizen, you're moving out, it doesn't exempt or change the status of the tax deferral. You'll still pay tax. That being said, it might be wise before you move out of the country, if you're living like a California, New York, just to establish residency in like a Florida or establish residency in Nevada for 6 months and a day, and truly move there or a whole year, whatever, right? Before you end up moving to the final destination, that could prove very, very valuable for your future taxes that you might be paying.
All right. How does the DST compare to a monetized installment sale?
Oh, such a good question, right? So the monetized installment sale, we've never done that before. It does offer a 453 through that. It's on the Dirty Dozen list now. It just failed in IRS court. They over the years have been, I call it competitor in quotations, because they did offer the way they do. They say, hey, you get 93 basically and 0.5% funds up front. You can do whatever you want with them. It's tied to this 30-year note that's secured and this whole thing. And basically you can have freedom for all of the funds to do whatever you want. We always thought that was taxable unless you were a farmer. We never thought it would work. We've never touched it. And unfortunately, the IRS and the tax courts confirmed that, and it's now on the Dirty Dozen list. It's failed. So number two, I think those who offered it, I don't know that they offer lifetime audit defense. A lot of and then the audit track record for anyone, whether it be the monetized installment sale or any other kind of installment sale that you might be looking at, it's not just the strategy or the idea, it's the team to execute, and it's the IRS track record for the audits. And so my business partners offer lifetime audit defense. I don't know if the monetized offers that or ever did lifetime audit defense. Also, the people that are actually forming the trust, they're the ones providing the audit defense. So it's all about the protection and the audit defense for us. Those are the main things that I would say are the differences. But we don't do them because it's on the Dirty Dozen, and we didn't think it ever really worked unless you were a farmer.
So that leads into our last question we're taking for tonight, which is, how long have this DST, how long have these been available, and how thoroughly have they been tested and even litigated in tax court?
Yeah, the most important question. So over 27 years now, thousands and thousands and thousands of closes, billions and billions and billions of assets used it. Over 24 no change IRS audits. Now of those, most the personal audits were no trigger audits, by the way. So they weren't triggered by the DST. They were just large deals that happened to get audited, and then the DST was audited as a part of that. There's also formal audits or promoter audits. These are all no change, no findings, which is actually remarkable. And if you think about this for a second, if you or I were to get audited on our business tax returns, there's something on there that we forgot a receipt, or, there's something where we probably would have to owe maybe a little bit of tax, right? These have all been no change, no findings, batting 1,000, look back in Washington, D.C. There's also a private letter ruling that was approved in form and substance on this. National law firms. I'll tell you a story, though. I think that, I can give you all those stats, but I'll tell you a story that's really powerful. And this is the story of David Young. David Young worked and built a business called PIMCO with a gentleman named Bill Gross. And this is one of the largest money managers in the world, and with 5 other guys. And did this for about 20 years. And they all retire, get a big payday. And if you can imagine, if you manage some of the biggest wealth in the entire world, you get approached with a lot of people pitching a lot of tax ideas or strategies to throw out to your clients. Well, David, about 5.5 years ago, got approached the Deferred Sales Trust. And in fact, you watched that video in the very beginning. He was the one at the end that says, I hear a lot of these things, and most of them are not worth the trouble, right? They don't pass, they're offshore, they're doing all these, weird, funny things. He goes, but we studied it, and they studied it for 2 years, and their legal team. And they're all of this for 2 years. Flew back, met with my business partner, mapped it out all on the whiteboard for a couple of days. Long story short, they are part of the DST inner circle, and so they can offer financial advising for the team. And so what I ask people who ask that question, it's a great question, is if it's good enough for David Young and his legal team after 2 years of due diligence, and they manage some of the biggest wealth in the entire world and get approached with this stuff all the time, is it good enough for Anna, me, anyone who's listening to this? And that gives me a lot of comfort, because it's not just a tax preparer or CPA or a tax attorney, which we have all of those national law firms. We've never lost an audit. It's never gone to IRS court. To answer his last part of the question, never gone to court, but we believe that the audits themselves on actual cases, and those are all no change, no findings, are even stronger than that. And we're batting 1,000. So it's perfect so far. We'll see what happens here in the future. But we also think that the installment sale is the foundation of actual, business ventures, because in the 1920s and 30s, when everything hit the fan with the Great Depression, the banks seized up, and when banks seize up, commerce kind of stops. And so they had to make a way for people to actually sell assets and become the banks themselves in order to keep the money flowing. And that's why we believe that the 1031 exchange is on. Sometimes it comes up on the chopping block for Congress to get rid of, whereas the 453 is not even being looked at. And so that hopefully answers the question. On top of that, we provide lifetime audit defense, state or federal, no additional charge. So we stand behind what we sell. So.
Awesome. Such fascinating content. I learned so much. I really appreciate you being here and sharing your knowledge and clearly your passion for the subject. And with that, we are going to bid everybody a good night wherever you are in this world. We've got many people here joining us from lots of places, which is awesome. So thank you all for joining us. And we will send out the replay as well as the deck in the next day. Thank you, Brett.
Thanks, everybody. Thanks, Anna.